Let's continue our discussion on savings instruments by talking about money market deposit accounts. These are similar to checking accounts because depositors can write checks on what are called money market deposit accounts. And they're insured through the FDIC, which is that government agency we talked about that protects you from losses on your bank account. But don't confuse money market deposit accounts with money market mutual funds. Money market mutual funds are offered by financial institutions other than banks and are not insured by the FDIC. And so many of those are offered by mutual funds and brokerage firms. So those are going to be a little bit riskier. An increasing number of money market deposit accounts can be combined with statement checking accounts. So the interest paid on these accounts may be less than the interest paid on statement savings accounts, especially when there's no limit on how many checks you can write. In other cases, the interest rate may be higher than the rate for statement savings accounts. And rates are going to vary from one financial institution to another. So let's just summarize the advantages and disadvantages of these money market deposit accounts. On the plus side, you can have periodic withdrawals. And the interest paid on your savings increases as general interest rates increase. So that means what we've got a variable interest rate again, just like with our statement savings account. And they may pay a higher rate of interest than regular checking accounts. Now, on the negative side, they usually require a significant minimum balance, and that may be as much as $1,000. They might not let you write a lot of checks because it's supposed to be more of a savings instrument than a money management tool. Just like before, the variable interest rate can be a negative and a positive depending on what's happening in the economy. And lastly, the interest may be higher than a checking account, but may be lower than a savings account, because this is kind of a hybrid account. So now let's talk about our last savings instrument, and that is U.S. savings bonds. So savings bonds are actually debt instruments that are issued by the U.S. government. The person who buys the bond is lending money to the government, which makes the government the borrower. Some savings bonds, like the Series EE, are purchased for 1/2 their face value, and then later on you cash them in for face value. Others, like the Series I, are purchased at face value, and those bonds actually have a variable interest rate that lets them help keep up with inflation. That's actually what the I stands for. So now let's talk about advantages. I'll just call these pluses and minuses or disadvantages of savings bonds. The advantages, you can buy them for as little as $25. Second, they usually pay a higher interest rate than a savings account. If you get the double E bonds, their interest rates remain the same. So that's that fixed rate. And there's a tax benefit. You do not have to pay state and local income tax on what you make on these. That's usually part of the reason why people will buy government issued, whether it's federal or state or local. No state or local tax. And they're less risky than stock. Oops, risky. Because they're still a savings instrument. So now let's talk about the downside. The downside is if they're less risky than stock, that means that there's also a lower return than on stock, because we talked about this trade-off between risk and return. If you buy a Series I bond, there's a 3-month penalty if you sell it in less than 5 years. So there are some penalties depending on the bond and how long you hold it. So kind of similar to that certificate of deposit that we talked about. Interest rates can go down on the I bond. So E bonds had, or double E's had a fixed rate. The I's have a variable rate. And what else? Those are probably the main ones. And so there are different types of savings bonds, double E's and I's, and depending on what's important for you, there are different advantages and disadvantages for both.